So I'm going to explain a little bit to you about what's happened in oil and gas in the last year. In terms of stocks, it wasn't very good. But, and where we're going to go in 2019. So now I did this presentation a little while ago. Where's my, right here. I did my presentation a little while ago, so some of these slides are going to be as big a surprise to me as they are to you, probably. So let's just start off and figure out what were the big themes here this year. So actually, oil and gas as commodities did pretty well this year. Oil was up from 60 to 76 a good chunk of the year. Gas has just had a huge run in the last little while, last 2 weeks. But the problem was the stocks didn't move. In the United States, there was probably 10 stocks that had a nice run from March to June. And if you didn't buy them at the right time and sell them at the right time, you made no money. In Canada, during that same time frame, there was probably 6 or 7 stocks, all heavy oil stocks that had a decent run. But again, Jack, be nimble. You had to own them and not own them at exactly the right time, or you didn't make any money. So, and I guess a third theme would be US production absolutely stunned all analysts this year, going up way more in both oil and gas than anyone really thought humanly possible. So that has just been a real kick in the teeth to commodity prices in the last month. And then the last big theme was Canadian oil on sale again at the cheapest price. We now produce the cheapest oil in the world. I think we had WCS, our heavy oil grade, trading below $20 US a barrel for a good chunk of the last month. And that same barrel, when it could make it down to the US Gulf Coast for refining, traded at $67, the exact same barrel. So those are the 4 big themes, and sadly, none of them made investors any money. So again, you look at a chart of WTI, it actually had a pretty good run this year up until October 3rd, which was the peak. And during that run, there really was almost no movement in these stocks. If you look at the TSX Energy Index, certainly the Canadian stocks never did anything. You look at from where it was in January to where it hit at peak, 7%. Big deal. Who cares? So, and then one of the reasons is the Canadian diff for heavy oil, which is a big chunk of our oil production, probably 75 to 80%, maybe even more, of Canadian oil production is heavy oil, comes out of the oil sands. It's about 3.5 million barrels a day. So, and most of that goes down to the United States through our pipelines. But because we now produce way more, and we're going to continue to produce more, we've got another 120,000 barrels coming on a day next year, 150,000 barrels a day coming on in 2020 with no new pipelines. So the gray lines, the gray bars that you see there, that is the discount that we're receiving for our oil. So you saw in April, we were down as low as $15, $20 a barrel, and that's when heavy oil stocks started to have a massive run. They had a fantastic run. A lot of them doubled in just 3 months. And since then, as that discount has gone up, they've given it all back and then some. So you can see how the blue line, which is the price for oil, is just pretty painful. So it really has been a tough go for both investors and producers. And one thing that's quite different this time around, so we had more production than we had pipeline once before in the late 90s. And the heavy oil diffs did blow out quite a bit then. But we've never seen light oil discounts like this ever, not in the history of our country. So you saw that with there's just been, again, so much oil production, no new pipelines, which you can blame the feds, you can blame the provinces, you can blame certainly TransCanada and Enbridge, who saw this coming years in advance and did nothing to get these things going. A couple mega projects that each of them thought they could push through, but both got stymied in Northern Gateway and TMX. So we're sitting here right now with $24. So basically half the cash flow that we should be getting for our production isn't happening. So what does that mean for us? So you think that oil costs about $40 a barrel to produce. So if oil goes up from 55 to 70, that's $15. You know, from 40 to 70, that's your profit. So that's $30 profit per barrel. So 55 to 70, that's cash flow doubles. And so now when oil comes back, it's the same way. It gets cut in half. And so these stocks just get slaughtered, and that's what we're seeing this month as all the different things that happened in the last month, like Iran sanctions by Mr. Trump were waived for many countries. You saw the U.S. announce a record production increase of 400,000 barrels a day. And so all these factors have contributed to oil just collapsing in the last month, and we're not done yet. So these diffs have blown out because of all this production and lack of pipeline space, and that has just really stolen all the cash flow from the producers and all their stock momentum. Now, I will say, so what we're talking about here are the producers. These are what's called the upstream part of the sector. All that revenue actually isn't completely lost because someone's making money off that. And for us, it's a lot of the midstreamers, the big pipeline companies. So Enbridge, Gibson, TransCanada, what they're doing, because there's so much competition for pipeline space, they're basically, these guys are hard negotiators. They go to the producers and they put the boots to their neck and say, well, if you want to get your oil out at all, we're going to give you X. And X is generally barely above shut-even economics. So what you're seeing here is the wealth is being transferred from the upstream guys, where the smaller companies and a lot of more retail investors have invested, and it's going to the pipeline companies. Like I heard Gibson today, GEI in Toronto, they're making about $25 a barrel off these producers in a lot of cases, and they don't even have any upfront costs. Like, that's just gravy. It's not like they're spending money to get that $25 like producers is. They're just saying, no, if you want it into our system, that's what it costs. Do you want to do it or not? Or do you want to shut in production? So these companies are scared to death to shut in production and show the market that production is declining, so they swallow hard and they do it. So it makes it very, very difficult. And for some strange reason, Gibson is actually trading off that arm of or is spinning off that arm of that company that does that. So, and the same thing has happened in natural gas. So you're seeing natural gas in the last week in the States has done fantastic. It's gone from 270 to 350. In fact, I think today it hit 380. So, but in Canada, it's just not translating because, again, they don't need our gas. Their production has gone up so much, they just don't need our gas. So we use our gas as for our own consumption, and really down in the States, and there's no LNG yet. So again, we have the same problem as we do with oil. No egress, no getting rid of our hydrocarbons off the West Coast, and that's costing us billions and billions of dollars a day. So now AECO is the main hub in Canada, and so does, I don't know, probably 70% of our volumes. And so you see here that we're running around $2, but there's stations like Station 2, which is a secondary hub in Canada, runs about 10% of the volume. That hub has been negative for the last week and a half. So producers are paying to get rid of their gas, and not a little bit. We're not talking pennies here. Over $1 an MCF, and last year we saw that blow out to minus $7 an MCF. That's crazy, where producers have to pay the customer to take their gas, and not just pennies, but actual real dollars. So, like I said, natural gas broke out this week. There's the Henry Hub chart from a few days ago, and U.S. stocks have done nothing. There's one stock that broke out in the entire U.S. nat gas sector, Cabot Oil and Gas, COG. If you're going to own one natural gas stock, there it is. So, trades around 25 bucks in the States. So you are seeing some of these stocks pick up, even in Canada, but it's minor. It's just so small, and technically they all still look horrible. So again, one of the themes was U.S. production off the charts. There isn't a person on earth who would have said the U.S. would be up 2 million barrels a day this year, 12 months year over year. They were talking about, 1 million barrels, 1.2 million, maybe 1.4 million, because demand is growing around the world at about 1.4 million barrels per day per year. So we're just approaching 100 million barrels a day global demand. And the market said, okay, so the state's increase in production has basically met that. We're safe. But then, boom, in this month, we got a crazy update from the Energy Information Administration in the U.S. that said, no, we're up a full 2 million barrels a day. And that just sent oil into a massive tailspin. So lower 48 oil production in the States has basically doubled in 4 years. No one would have thought that. And same with nat gas. We're up 10 Bs a day. The States is now producing about 85 Bs a day in the lower 48. There isn't a soul on earth who would have thought that a year ago. It's just the industry has become so efficient, and of course their pipeline business is going like mad, whereas our pipelines can't get off the ground. They're going in, I think we're going into our 14th environmental review on a few of them. In the States, the pipeline business, particularly for natural gas, is going crazy, and I'll talk about that in a sec. So that was one of the big themes for this year, and that really helped keep a lid on prices. That was really a tough knock on prices in upstream stocks. So there's a chart of what U.S. oil production looks like. Like I say, back at January 14, we were sitting around 8,000. Now we're about 11.7, so sorry, not double, but 50% up almost in the last 4 years. And that just gives you a sense of just how much in the last year things have just gone crazy. And that's all out of the Permian. All of that's out of the Permian down in West Texas. Natural gas, dry natural gas production, again, you can just see how it's just, that chart has just taken off. And there's two reasons for that. One is the mighty Marcellus in Pennsylvania and Virginia that has gone from about 3 BCF a day to 25 BCF a day in the last 10 years. Absolutely stunning. And also again, the Permian. All the U.S., I've said many times, there are no oil stocks in the U.S. The U.S. is actually a very gassy basin, and whether it's the Bakken or the Permian, these oil wells turn to gas fairly quickly. And so you've got all this associated dry gas with oil, and because oil's done pretty well over the last 2.5 years, they've been drilling oil like mad, and that's really increased the dry gas production. The Permian's basically gone from, the Permian has 0 natural gas wells, and it produces 8 BCF a day. 10% of U.S. production comes out of the Permian, and it has no natural gas wells at all. It's just the associated gas from the oil. So in 2019, what are we going to see? Are we going to make money, or is it just going to be more of the same? Sadly, for the upstream small investor, I think it's going to be more of the same. Literally today was one of the big nails in the coffin for our heavy oil stocks. There was a group in the U.S. that got a court in the U.S. to stymie Keystone XL once again. It's going back for another environmental review as of today. So that means these really wide Canadian heavy oil diffs are here to stay. We had talked about getting that pipeline ready for Q1 2020. That's not going to happen. You can kiss every heavy oil stock in Canada goodbye, maybe except for Husky for the next 3 years. We are going to continue to see a lot of U.S. production growth, maybe not quite the 2 million barrels a day we saw this year, but still a lot. And investing in these juniors, particularly the Canadian juniors, where the diffs are so bad, doesn't make any sense. And it's crazy. We've seen this unbelievable multiple compression where 4 years ago we were trading 11 times cash flow. Every increase in production meant a big jump in stock price. And now the very best companies are trading at 3 times cash flow. All the companies who are presenting at my conference in Calgary in 2 weeks, we're just sitting here with our jaws on the floor. They're getting paybacks on their wells in less than a year. Their balance sheets are in fantastic shape. We're enduring all this, tax loss selling, and they're trading at 3 times cash flow. No, so that's not just me talking. When I talk to the old timers who've been around, 4 has been like the trough at all the bottom valuations, and now we're trading 2.5 to 3 times cash flow on a lot of these stocks. And they're going lower between now and the end of December. They should have a nice fat pop in January when the selling pressure comes off, but they're not going to go back to the old year highs that they had. And then, of course, we've got one other thing coming in 2019. I really believe we're seeing a market top here. We're going to see a lot of choppiness, I believe, in the big boards, possibly even a bit of a downdraft through 2019, which is going to be a big headwind for oil and oil stocks. So much like Jordan said about gold, it's all about raising cash and getting your hedges in. And if you do want to play these stocks, you want to place oil stocks that are in places other than Canada, Colombia, the States. Now, where could we make money in 2019? Could oil turn around? Yes. There really is 0 spare capacity in the world. So every country is producing as flat out as it can. And there's 0 spare capacity. So if there is a hiccup anywhere, we could end up being in trouble. But what's happening right now is Africa is getting its act together. Nigeria and Libya are really picking up production. Peace is breaking out in a lot of different places, but not Venezuela. So if Venezuela truly goes to zero, which is possible, then that could be a bullish imprint for oil. And of course, you've got the usual Mideast powder keg. You never know, particularly with MBS there now, what could happen. You're never more than a phone call or a click away from that powder keg exploding. So, so really what we're doing in our portfolio, we're raising cash. Even though stocks are trading at only 3 times cash flow, we're not buying them. I just think we are at peak negativity here, but coming down from that peak is going to be a very shallow climb, very shallow walk. It's not like we're going to go back to a raging bull very quickly. So happy to sit on cash and even take a small loss here on a lot of my positions just to have that ability to deploy wherever I want. So one thing that's really interesting, I guess, is the U.S. senior nat gas names. Like I said, Cabot is the one that I do own, COG. Southwestern is another huge producer with lots of leverage. That management team drives me nuts, so I don't like them, but the chart is about to break out. Pipeline stocks. I just noticed in the last month they had fantastic Q3s. They've bounced off oversold conditions, so everyone's forecasting, you know, anywhere from 6 to 8% EBITDA growth over the next few years for a lot of these names. So that's a possibility. If you do want to play the junior market in Canada, I'd say Vermilion, VET, is the one to watch. When big institutional money comes back to Canada, and that won't be as long as Mr. Trudeau's in power, you're going to, and he is going to win next year. So you're going to see no big institutional money flow come into Canada to move these stocks. You need institutional money flow to make these stocks go up. Retail does not make these stocks go up. The first one that all the big institutions are going to buy after Suncor and CNQ is Vermilion, VET. When you start to see VET pick up, that's your sign that, okay, there's some love coming back to the junior market. I'm willing to take a risk on some of these smaller stocks. But, and certainly for nat gas, 7 generation, symbols VII, they'd be in the same position where when real money flow comes back to that sector, that's where it's going to go first. And then again, if you want to own a junior producer, it's Parex. That's the only one you really need to own. PXT trades around 17 bucks. Stay far, far away from anything under 10 bucks because the market is just not going to care. They might be doing great. I own some of these stocks that are doing absolutely fantastic. Yangara, YGR, Tamarack Valley, TVE. They are doing fantastic. Even with all the crap that the market's thrown at them, they're getting fantastic results, quick paybacks, and they're trading at 2.5 times cash flow. So, you know, and so when they come back, they might go to a little bit higher than where they're at now, but they're not all of a sudden going to go back to like 5, 7 times cash flow and start rocking unless there is an absolute game changer in the oil market. So I think when I'm talking about pipeline stocks also, it seems to me that the nat gas pipeline stocks are doing much better than the oil pipeline stocks. So that's something I'm going to spend a lot of time on in the next few business days researching. So I wish I had more happy news for everybody. Like part of me says I should have come up here with a dunce cap on my head because honestly, I haven't made anybody any money this year. We had a couple stocks that did well, but again, you had to sell them at the right time. The only reason my portfolio is up this year at all is because I actually have a massive position in a non-oil and gas stock in my portfolio. So otherwise, it would be quite red. And so we're just at a stage now where everything about this market says we should be putting in money. It's tax loss selling, it's trough valuations. These companies are actually doing really well, but I'm not buying them, and clearly the market's not buying them. So only time is going to tell if we are right or wrong here. There's absolutely a strong argument that says, you know, a full year from now, could these stocks be at 50% higher than where they are today? Yes, but boy, you better have the patience of Job and big kahunas to own them through all the volatility that's going to be happening with that. And I'm around here for a few minutes after the presentation to answer any questions. Thanks for coming out today, and God bless.